Hi there, everyone, and welcome to the Christmas edition of On Track, December 22. It's the 21st of December at 4 p.m. as I record this. I'm 2 meetings away from finishing off for the year. It's been a fascinating year, and it's still fascinating as we go into 23. So this is the monthly update for clients of McGregor Wealth Management, particularly those that use our care methodology. And for anyone else, as usual, my warning, feel free to listen to this, but don't act on anything without making sure it's appropriate to your own circumstances. So I'm going to cover off on economic news today, and the topics are still the same that we've had all through the year. I'm going to update on the key markets, where the portfolio is up to. I'm going to talk about what we've been focusing on in 2022. When I say we, I mean the global markets and what to expect in 2023. Talk about what's happening in property and shares and put it all in perspective. The news highlights, and there's not much new news around at the moment. So the news has been dominated over the course of this year as we look back by inflation concerns, rising interest rates, and supply chain issues. And these all are feeding into each other, with supply chain issues causing inflation. And part of that supply chain issues has been around the Russia-Ukraine war and China in lockdown and trade wars. That has dominated the news, and that's kept the market volatile. Australian residential property prices, after a great run post-COVID, cooled off this year. I'll take you through some figures shortly. And we had conservative bond investors lose money for the first time since the 90s, as interest rates kicked up for the first time properly in 42 years. And all of these topics, I think, are going to be the hot topics for 23 as well. And I'm going to talk about what keeps me up, or not what keeps me up, but what I keep an eye on over time. And as we look down the right-hand side here, we can see the RBA cash rate now up to 3.1%. The chart here shows it coming back off the floor, though. The zero rates were the unusual thing, as much as we're all feeling the brunt of it into some degree, particularly mortgage holders. It should be no surprise when we look back to 1990 and see that at that stage, cash rates were up at higher than 15%, quite staggering. And now we're right about 3%, but that's because we're coming off the bottom. All of a sudden, 90-day bank bills, 3.19%, 10-year government bond yields have steadied around the 3.58%. The Aussie dollar seems to be finding its space around 67 at the moment. Inflation, no new numbers from the Aussie. We only update our Aussie inflation numbers every quarter, so no new data there. The US dropped, and that's why we saw a bit of a share recovery in November, was because the news was looking better. I'm going to talk more about the good news, bad news cycle again. Mortgage rates have just been jumping up with cash rate. So as the RBA cash rate's gone up 0.25%, so too have mortgages. The lowest mortgage I can see around is 4.44. Most people we're talking to have mortgage rates in the 5, some as high as right up to 6%. I can't say enough. It's worth looking at this every year, whether you're renegotiating with your bank, refinancing. The difference 1% makes on a $500,000 or $1 million mortgage is worthwhile looking at refinancing or renegotiating. Macquarie, who seem to be fairly well positioned, and the only reason I show them here is to have some consistency, because we see the lowest rates. Often those lowest rates are small institutions chasing business, but the Macquarie rate is obviously a large institution, about 4.79, so it's jumped another 0.25%, the same as the cash rate. What was interesting this month, though, is even though the cash rate jumped another 0.25%, term deposits for 1 year actually, with Macquarie at least, went down. We are seeing more players. Macquarie did push theirs up quickly in a chase to win lots of money. And you can find 4% if you look. So if you've got cash that's around for a while that doesn't need to be long-term invested, there is sort of 3.5% to 4% for that 6 to 12 months. Let's dive in. Now, I get a lot of questions at this time here about what are my predictions and what are my projections for 2023. And I always smile a little bit, because I'm very aware that no one, not me, not anyone out there, can make accurate predictions about the stock market. The only accurate prediction I make, I'm drawn back to a story that's supposedly in the 1920s. The JP Morgan was asked, what do you think the share market's going to do? And after a pause, he said, young man, it's going to fluctuate. And as flippant as that sounds, that's the projection for 2023. We're going to see some fluctuations. But I do say this while we're looking at this chart here that goes from 1900 to 2020. It's a log chart, so you'll see it goes 10, 100, 1,000, 10,000. So it pretty much shows that the share market reinvested goes up roughly 10 times every 40 years. It's pretty spectacular. So you take those only two principles. And so what I've been saying to people is you can't invest based on projections. There is no person alive who's consistently made money over the long run out of predicting what's going to happen to the economy and the market. But you can make extremely good money by using principles. And the core principles are, yep, the stock market's going to fluctuate, but it's going to go up in the long run. So if you can work out ways not to panic and not to lose money when markets go down and to hang in there, you will absolutely make money in the long run. And that won't, I don't believe that will ever change. I believe that occurs because of innovation, because of evolution. We get faster, stronger, better. We get up every day, we spend our money on our groceries and on other things. That goes into companies. And the evolution amongst those companies is quite incredible. Some things going on in the world. The good news that we don't hear on development of artificial intelligence, robotics, and medicine, the screening medicine types is quite amazing. And I just think all that feeds in eventually when we stop worrying about the things that we worry about. Returns to the end of November, we saw a big jump. So growth returns, the high growth fund there up 4.5%, quite staggering. Quite amazing about that 4.5% in a month. Aussie shares jumping, and where are we? So Aussie shares up about 4.3% in the month. Now, we had a big negative month the month before, and we're sort of riding a little bit of negativity at the moment. So it's quite volatile, as I said before. If I look at the long run down at the portfolios in the bottom, 7 years returns tracking at sort of 3, 5, 6, 7, and nearly 8, which is about bang on the longer term targets for the portfolio. And that's while we're still in the ditch. And it's always, you've always got to be careful measuring long-term returns in the ditch. You're better off to measure those as we hit new highs to get a good idea. But certainly it's still hurting. For the last year, at the end of November, portfolios, high growth portfolios down about 3%, balanced portfolios down about 2%. And as we roll into December, there's been a bit more weakness. So that's currently sitting at about 5% across the board. I want to go through another behavioral bias. I've probably been through this before, but this one is one of the biggest one we see. And when we sit down every month at our investment committee meeting, we're very careful to call ourselves out on any confirmation bias. And confirmation bias can be the biggest enemy. And confirmation bias is just when we tend to focus on things that support our argument or our existing beliefs. So if I think inflation's going through the roof, I'll pull out every bit of data that I can find to confirm that, and I'll ignore stuff that might confirm the opposite. And this happens because, as human beings, there's a lot going on. So we mentally use shortcuts to make decisions, because otherwise we just wouldn't be able to function. These shortcuts are called heuristics. And so we tend to chunk things together, and we use this confirmation bias to confirm our belief. And the problem with it from an investment point of view is it means we tend to ignore things that are inconsistent with what we believe in. So we just won't look at them, or we'll write them off. So an important part of our process is making sure we continually evaluate what others are saying, whether it agrees or doesn't agree with our own thoughts, with our own projections, with our own beliefs, and it's something we do regularly. This comes to life if you're. I see this, a classic story about this. I see people that might have sold a property, and they've sold it because they think the market's going to fall, and they want to buy back in when it's cheaper. Now, a dangerous thing to do, because the market goes up most of the time and only falls occasionally. But what happens to their confirmation bias when they do this? they start to focus on every negative case that's going to believe the market will fall. Even if there's a lot of news around that says, or a lot of research around that says it might not fall. So very dangerous in the investment world and one to be aware of. I'm keeping this chart in at the moment because it quite neatly shows the last 20-year cycle, boom, bust, wall of worry. We're slowly coming out of this last little dip, which is just another one of these fear, and it's been all about the inflation. The bond yield, which I've talked about a lot in the last year because it's jumped so much. I mean, the bond yields come off, from 1% all the way up to the 3s and 4s. The Australian yield curve on the left, we can see, is now settled. It's dropped. The orange dotted line was where it was 6 months ago, the green dotted line where it was 1 month ago, and we see it's dropped. And the 10-year yield is now about 3.5%. 20, 30-year yields, a bit longer, but that's a normal yield curve. And you see down the bottom, the yields, that's the rate of interest that's paid on 10-year bonds, has come off those record lows of just over 1% up into the mid 3s. And you'd think it's probably going to settle there. Same for the US. It's now up to 3.5% off rates that were sub 1%. And, we kind of think the new normal for bond rates might be between 3 and 5% fluctuating if inflation is kept under control. And the only reason it would go up beyond that is if inflation lasts longer and it takes more effort to get it under control. I want to talk about, last time I talked about the news cycle, but I want to talk about the things that potentially we think about as worries. But I want to point out how every worry is also potentially good news, which could be good. So at the moment, the top worry list kind of looks like this. We've got inflation, which everyone's talking about. It could go longer than expected, but it could be shorter than expected. And if it's shorter than expected, that will be good news that will send the markets up. So they're both possible, but once again, the media is going to focus on the negative. The Russia-Ukraine war, it could drag out forever, but it may not. It probably won't do that. At some stage, it'll be resolved. And at some stage, it may have less impact as well. At the moment, we're in a European winter. Europeans had been very dependent on Russian oil and gas. They're currently making themselves very not dependent on Russian oil and gas. So next year, we should see energy prices drop, even if that war grinds on, because the world will have got other sources going, etc. China, and particularly hear about China's supply chain issues around COVID, but also their trade wars. That's something we worry about that could get worse, but it could get better. As we record this today, Penny Wong, the Australian Foreign Minister, is in China, and the US Foreign Minister is due to go there in January. And China's sort of got the carpet out at the moment. They're kind of willing to talk. They need trade, probably more than we and the US, and that's probably not quite true, but they definitely need it. They need growth to keep their people, their standard of living rising in China, and they need our resources to do that. So there's potentially some good news may start to emerge from there, or some less bad news, as I talked about last time. US politics, we've seen a roller coaster year. The midterms didn't go the way many thought it would go, which was going to be a swing to all the Trump-backed candidates. It still left the House divided. So they've got a two-house system in the US, not dissimilar to ours, but quite different as well. We don't have a president, of course. They've got to get legislation through both houses. And at the moment, the Democrats, Biden-led Democrats, no longer control both houses. So that's going to make them hard to get things through. So we're going to see a revisit of things like the debt ceiling. We're going to see the Senate make it hard for them to pass sometimes day-to-day legislation. So that's going to cause some instability. But we saw some good news there because there seems to be less extremism there on the political side. And it seems to me that Trump is being slowly pushed to the side, and the only votes he's going to attract will be those with extreme views. That follows into the extremism around the world, that we see the noisy minorities in any debate, whether that's climate, whether that's politics, whether that's immigration, whatever. We only hear from the noisy minorities, and the quiet middle, as John Howard called it, are unheard. And hopefully we'll also see the rise of the middle and not a swing to the left or the right. because it does drown out debate from people who are rational, who have good ideas, as we gravitate towards the extreme. The other thing that I worry about is the catastrophization. I'm not sure that's a word. I'm putting it down the road of everything. Everything is the worst thing ever, and they're quite clearly not. And yes, we've seen some nasty weather events and other bits and pieces, but they're no nastier than stuff we've had throughout history. They seem to be more frequent, and maybe they are, but it's also the fact that the media loves reporting on them. And we now hear about everything everywhere around the world because the media is everywhere in the news. Now, there's always, as we roll into every year, there's always this concern about a black swan event. And a black swan event is something that no one's thought of. We've been so focused on all these other things all year that the next bit of bad news could be something we just haven't thought of. And that's why it's called a black swan. But equally, you can have a white swan event. And the white swan event would probably be the easing of some of these things on this list here. And the white swan event, which would be the biggest of all, if all of a sudden we had all of these things become a bit less bad or good. That is Russia, Ukraine, of course, has some sort of truce. China opened up a little bit and the supply chain certainly opened up, and China's growth came back. Inflation pared back as some of these energy price and other things peel out of it, and we see a bit less of extremism for whatever reason. That would be tremendous news. And you stack that all together and, who knows, the share market would certainly take off. We haven't had a boom now for 20 years. Not saying there's one about to be born, but they're always born, as I said at the start of that, on pessimism. So always better to be in the market than not in the market. And just a repeat of what I went through last month, the news only has to be less bad to be good. Now, this always sounds funny, but I'll give you an example. If someone's expecting BHP to make a lower profit by $2 billion and they only make a lower profit by $1 billion, the market goes up. Not because the news was good, but because it was less bad. And the same is if the news is expected or unexpected. So news that was expected, like when we get the inflation numbers at the moment, it's kind of expected, so it doesn't move the market. But if news is unexpected, it can have a big impact on the market. So something to keep in mind as you see the news. And let me just click through some of these. That cycle, boom, bust, wall of worry, which we see play out again. We're quite firmly in the wall of worry at the moment, and we're nowhere near breaking to a boom, nor are we likely to go into any substantial bust. This chart shows all those major downturns that we do worry about. Every single one of them has come after a boom, except for COVID, which came because we shut the world down. We're nowhere in the sort of conditions that would be described as boom conditions in world equity markets, which makes it quite unlikely that we would see a downturn in the share market of more than 20%. The two biases or the two mess it ups that I want to focus on for the rest of this today is that short-term focus. I showed you that chart earlier from 1900 quite deliberately, because in the long term, the stock market going up is almost like gravity. But our focus on the short term and trying to predict what's going to happen next year, next month, next week is so unproductive, because it causes people not to invest or not to leave good investments alone. So that short-term focus can be extremely costly. And the other one, and when I go through the markets in a minute, I'm going to talk about what the index has done and what the average fund manager has done, which in 93% of cases is way below what the index has done, which is why we use the index for most of our portfolio. And that's because nobody can consistently predict the timing and selection of assets that are going to do better than those averages. And I'll give you some examples as we go through. Our care philosophy, as always, splits your portfolio into 4 buckets based on your own plan and the returns you need to get. But this incredible nerdiness that we have about understanding history and the inevitability of that kind of repeating over time, and also our focus on making sure our clients are educated so they're not likely to make those behavioral bias mistakes that most people do. And then we can run the portfolios professionally so they achieve what they achieve, which is above average returns with below average fees. Let's have a look at the market. So the Aussie share market to the end of November, up 6.48% for the month of November. But you can see on the right-hand side here, it's down again in December already. So we look like we'll have a negative month unless it rises up on the low volume through Christmas. There won't be much trading going in the next few weeks, but there's always trading and the market does react. But I want to have a look down the bottom here. I talked about different, the ability to predict markets, but have a look in the last 12 months, see the 1 year return of the top 10 stocks in the ASX 200. So BHP had a 33% year, pretty good. Woodside, 80% year. What do they have in common? They're miners, and the miners had an unexpectedly good year because of supply chain shortages, because of the rise in energy prices. And Woodside, which is petrol and gas or oil and gas, had a spectacular at 80%. Now, there's no way anyone before the breakout of the Ukraine war would have thought, gas and oil prices were going to go through the roof. So this is why diversification is so important. The worst performer, Macquarie Group, a great company, but had been inflated, down 14% for the year. Sorry, Wesfarmers worse than that. And Wesfarmers is a great business that owns Bunnings, amongst other things, but they had a negative year. And this is why diversification is so important. The chances of anyone predicting those types of spread of results over 1 year is absolutely impossible. And then on the right here, this chart shows the value of $10,000 invested over time. The index will get you 29,620. VAS, which is what we use to emulate the index, gets pretty close to that. But the category, that means the average fund manager, only 25,000 over that period of time. So the people that promote themselves as able to beat the market absolutely don't on average. And that's consistent across the board. US shares up 8.76% for the month. You'll see there in the top 10 down here, the variety there as well. Now, look how badly tech was bruised in the last year. Apple down 22%, Microsoft down 25%, Amazon down 50%. You've got Google down 37%, Tesla down 51%. What's gone up? ExxonMobil, so oil and gas, once again, very unpredictable. And US shares are still negative over the year. And part of that was also some Aussie dollar. But look at the spectacular returns in the long run. $10,000 would have grown to $59,000 in the index. VTS in this case, the index fund that we use has done better than the index, and the category, the average fund managers, way below. So, and that's why the index investing works so well. US small caps, a modest month actually. They didn't go up by as much, and once again, the importance of diversification. And I'm not going to go through any of those companies because I don't even know any of those names. This is why we love US small caps. You get exposure to 10,000 or so small companies in the US that are all innovating, evolving, and in the long run, grow longer. You'll see that here, $10,000 grown to $54,000, $52,000 for IGR, who we hold in the portfolio, only $46,000 for the average manager. Global leaders, so these are the top 100 companies in the world. Once again, they're companies like the Apple, the Microsoft, etc. And they had a modest month, mainly driven by tech, etc., but a spectacular decade. Not such a great year, down 2% for the year, but absolutely for the long run, gone up consistent with those principles that we talked about. Emerging markets has been the problem child of 2022, mainly because it covers areas like China, like Russia, like Brazil. It's important to note that there's no Russian stocks in this index anymore. They were taken out just to make sure people could feel comfortable about their investments. But that's also had an impact. I imagine there's a lot of Russian companies that probably made a lot of money last year with inflated oil prices, but they're no longer in this index. Emerging markets traditionally, when I say traditionally, over the last 100 years, have generally outperformed developed markets, but not in the last 10 years. We've seen that with different things going on. We fully expect that to come back, which is why we keep them in and why we keep rebalancing into those markets. So I would expect emerging markets to look quite attractive over the next few years as they start to return a bit of stability. You see some great companies in there too, companies like Samsung, who everyone's familiar with, Taiwan Semiconductor that makes all the silicon chips, a lot of the silicon chips in the world, because they come from countries like Taiwan, South Korea, etc. Moving on to gold, and gold had a modest month. It was up 2% for the month. For the year, it was only up 4%, but as I look to December at the moment, gold's actually having a bit of a run at the moment, which is quite interesting. Part of that is the US dollar being a bit weaker. Part of it is the fall of cryptocurrency and some alternative investing that would otherwise go into things like crypto have come back to gold. That's going to be interesting to watch, and we do value having gold in the portfolio. Property markets, they go through that long-term boom-bust cycle as well, with a whole lot of boring in the middle. We use the property clock as an analogy. And it's been a fascinating year in Australian property. In the last 3 months to the end of November, pretty much red ink all around the country, but a big difference. Brisbane down 5.6% there. Two exceptions that went up: regional Western Australia and regional South Australia. So, that's areas obviously around Adelaide and Perth, quite fascinating. The regional areas generally did better last year than the capitals. It doesn't always happen. The overall downturn across all the combined cities, minus 3.5%. Over the 12 months, a much more varied story. Adelaide went up 13% in the last 12 months. Perth went up 4%, and this is why it's in Darwin up 5.5%. So these are markets that are still ahead of where they were 12 months ago. Melbourne and Sydney are the ones that copped it the most. And given most of the media comes out of Melbourne and Sydney, is why the property media can feel a little bit negative. Certainly here on the sunny coast around Noosa, we've probably experienced similar to Melbourne and Sydney. So we had strong growth, but a cooling off of that growth, but still way above pre-COVID levels, and quite healthy to sort of pause for a while in the markets. We still see some good value in certain places like Perth, like Adelaide, and like some regional areas like Toowoomba, and I'll get to those in a minute. But rental growth just spectacular. Anywhere from 5% up to 13% rental growth, 10% across the country. Not so great, for those who are renting. Good for those that own property, but I would point out that those that own property, most have debt, and that debt has gone. The cost of that debt's gone up completely as well. But with vacancy rates so low, that means that there's little chance of rents going down anytime soon. And with immigration coming back big time in the next 12 months, with expected 240,000 people to arrive in Australia, that's going to keep the pressure on rental markets, which will put a floor on the price as well. Those rental yields, I thought this was interesting, looking at where you get different yields, and these are averages, of course, but when you look at the highest yields here, a regional Northern Territory, we've got a couple of clients that own properties in places like Kununurra, and we do see them get very good yields. It's a tough market. I certainly wouldn't recommend anyone buying there unless they know that market well. In our case, our clients that are there have built those properties, businesses they had in those areas, but spectacular yield, 7%. Darwin itself about a 6% yield, right down to the bottom where you got Sydney on a 3.1% yield, Melbourne on a 3.2%. So at the moment, places like Perth, which are yielding 4.6% in Perth itself, but you don't have to move too far out of Perth to get 5 to 6% yields in places that are growing quite strongly, and regional Queensland as well, up to 5%, and slightly higher in places like Toowoomba, which is where we see the potential for property to be not too expensive and to still have growth potential. So be careful in interpreting this stuff. Always happy to talk to you about what's happening whether you've got a decision about buying or selling. And as always, it's best if it's part of your plan. I'm still thinking that it's not a great time to be fixing rates. We've had rates go up dramatically. If you're trying to fix over 3 or 4 years at the moment, you're paying 6 to 6.5%. And while we've got rates go up to 5 at the moment, and maybe they go up to 5.5, maybe they even get to 6. Unless they've marched all the way through there, it's just not worth fixing. And there is a chance, I can't really say how much of a chance, that as eventually, as the Reserve Bank stops pushing rates up, rates may actually come down again somewhere over the next 18 months. And yeah, they might settle potentially in that 4 to 5% range, which, yeah, up until COVID, we thought was pretty normal. You know, you go back to 2019 on this chart, and rates in that 4 to 5% range. So yeah, it's like I said, all predictions are useless, but that's kind of where we think it's going to settle from here. But whether that's in 6 months, 12 months, or 18 months is really, really hard to tell. And the property clock, from our friends at Performance Property, who help us find investment properties for our clients who are looking for that as part of their wealth creation. They still have the value areas around Perth. Interestingly, we had a presentation from them this month, and they did a lot of presenting about some of the areas in regional Queensland in particular, which have good prospects. I tend not to favour two regional investments just because of how limited the markets are and how dependent they are on local economy. But, you know, places like Rockhampton and some of these others have a pretty good story right now. But be wary, but they are an opportunity. We've got some young clients that you know, have lesser price points than what they're buying, and they can often get good yields and lower price points in places like that. We do always stress that whenever you're getting those good yields in those places, you need to use that yield to pay off the debt, because you're likely to get less capital growth. So Perth's still a pick, but I would point out places like Toowoomba, yeah, highly attractive for bread and butter investment property. Still bits of Brisbane, even though parts of Brisbane are mature. So there's always value to be had, and we're seeing places like Sydney, Melbourne kind of at the top of the clock. It's not predictive, this stuff, but it just tells you it's expensive. And when it's been expensive for a while, it's less likely to grow stronger in the next little bit. But we do have, yeah, it's easy to come up with some events that could see property be stronger for longer, and that would be immigration and some sort of easing of interest rates. But we'll see. Be careful with all this at the moment. Happy to help. So just summing up before we wrap up, as usual, all investing should be done as part of a real plan. That's where you've got goals based on your life and what's important to you. The portfolio is designed for one reason and one reason only, and that's to meet those goals. That's to lock in a reasonably predictable return. We can't get it perfectly predictable because markets fluctuate. We do take a long-term view. That means we can apply principles rather than predictions, and massive diversification, which keeps the portfolio as steady as it can be. And the index, and I showed today, the index outperforms most managers. When I say most, 90 to 96% of managers. And we protect against that short-term volatility with reserves for our retired clients, and by averaging in for our other clients and rebalancing regularly. And as always, there's only 3 ways to lose money, and we say don't do that. Panic and sell, have to sell, and not properly diversified. And congratulations again. Throughout this downturn, we have had no one panic and sell. We actually had people take advantage of the dips, and certainly for our longer term clients, they've hardly even worried about this. I want to take the chance to thank you again. We very much value the trust you place in us to look after your financial world. We take that very seriously. It's a long-term game for us. This business next year will celebrate 25 years. So some of our clients literally go back 25 years with us. We're busy planning to make sure we're around for another 25 years by building up a great team that supports me here. So I wish you a great Christmas, a great 23, and look forward to catching up soon.